Hello students and welcome to this question that covers both PPE and investment property. I think this was quite a good question and I've chosen it because it covers a wide range of property, plant and equipment principles, which of course also apply to investment property, especially in the case where we go between the two and where PPE becomes investment property or the other way around. So this is quite a good example of how to do the calculations both for IAS 16 and IAS 40. I want us to read together. It says Bootbusters is a company that produces rubber boots. It has successfully established itself within the South African market through selling its rubber boots to a wide range of customers. This company has a 31st December year end. Then it says they have an accounting policy. Buildings classified as PPE is carried on the cost model. Investment property is carried on the fair value model. Machinery is carried under the revaluation model. And revaluations take place at year end. Revaluations are performed by eliminating the accumulated depreciation, which means we use the net replacement value. And then vehicles are carried on the cost model. They have given you an asset register. As you can see, they have 2 buildings, 3 machines, and 2 vehicles. They have a note referral. They have the cost price. They have a residual value to the asset. They show the accumulated depreciation at the beginning of the year. They display the useful life of the asset. And they also show how it is depreciated. As you can see, they use the straight line method for the purpose of depreciation. For building A, in note number 1, it is said that building A is used as an administrative building, which means that this is a PPE building because your administrative staff use that building. So I'm just going to make a note for myself. This means that it is PPE. Then building B is rented out to a third party at a rental payment of 50,000 Rand per month. On 30 June 2015, the rental contract was discontinued and it was decided that building B would be reoccupied by staff members. So it used to be rented out. That means it was investment property and now it is becoming PPE because our staff members will occupy it as from 30 June, it seems. The fair value of the building was 3,200,000 Rand on 1 July 2015, while the remaining useful life was 15 years. On 31st December, the fair value of this asset was 3,250,000 Rand. Machine A has a net replacement value of 850,000 Rand at the end of the year. Machine B has a net replacement value of 400,000 Rand at the end of the year. Then machine C has a net replacement value of 1.2 million Rand at the end of the year. In note number 5, we are told that a vehicle, A1, was damaged in an accident on 1 August 2015. The fair value of the vehicle was 50,000 Rand on 1 August. The value in use was 55,000 Rand and it would cost 2,500 Rand to sell the vehicle. So they've given you fair value, cost to sell and value in use, so we know that we are working with an impairment. On 1 August, the vehicle had a remaining useful life of 23 months. In note number 6, vehicle 02 was stolen on 1 February. The insurance paid out a claim amounting to 220,000 Rand on the 3rd of February 2015. In the required part of this question, they ask you to do in number 1, the journal entries relating to note 1, note 4, note 5, and note 6. In the required number 2, they ask you to present the PPE note as of 31st December 2015 to indicate all your calculations clearly. And in required number 3, they ask you to disclose the note investment property as at 31st December and show all your calculations. Additionally, you are told you can ignore the comparatives. So I'm just going to open an Excel spreadsheet for us. And then we can start considering how this memo will pan out. Right, we're going to start with the required part of number 1. and we need to fill out the journal entries for note number 1. So in note number 1, you will see that there is a building A. So obviously for building A, we have, so I'm going to say this is journals for building A, and building A is PPE. We just need to properly indicate our debit and credit side. All right, so let's see the journal entries that relate to building A. As we can observe, building A is, of course, a PPE building, and they have given us information in the block. They say it has a cost of 1.2 million. It has a residual value of 200,000. The accumulated depreciation at the beginning of the year was 100,000. It has a 20-year lifespan. It's depreciated on the straight line. And in the information, they tell us that the buildings are carried on the cost model. So what we need to do is we need to recognize some depreciation on this building A, and because it's PPE, we need to take the residual value into account. Had it been the cost model and it is investment property carried on the cost model, then the residual value will have to be ignored in according to IAS 40. So I'm going to take that information and say we need to recognize depreciation. So I'm going to say debit the depreciation, credit the accumulated depreciation. And in this instance, we will have to go and do the calculation for this asset. If I look at the cost price, it is 1.2 million. I need to minus the residual value of 200,000. I need to divide it by the useful years, and we've not been given any changes, so we've had this asset the whole year, so we need not times by any months. So it's going to be 1.2 million, rather 1 million after deducting the residual value divided by 20. So that gives you 50,000 Rand depreciation on that specific building. Then we can also do the journal entries for building B. So if this computer just works today, there we go. Right, building B, and it is going from investment property and it should become PPE. So we need to do some journal entries here. So it is first and foremost, it is investment property. So that is where we will start. And the first information I see there relates to some rental. But the rental will only be received between January and June, because at the end of June, this contract is discontinued. So the first entry that I'm going to make is bank/debtor, and then rental income. And here we will take the 50,000 Rand per month and indicate that we receive it for 6 months of the year only, because then this contract is discontinued. Right, secondly, we need to take into account that this investment property will now become PPE. So the first thing we will have to do is recognize an revaluation. So if I look at the information given, they only give me the revaluated value as on 1 July 2015, and they say 3.2 million Rand. They have not given me a revaluation for any other time, so therefore I will have to work from the cost price. So the difference between the cost and the current revaluation on 1 July. So it seems to me like the value has increased. So I'm going to recognize here that investment property needs to be increased. And that is a fair value adjustment income. And now we need to go and measure the difference between the 3.2 million, which is the current value on 1 July, and the cost price, which is 2.5 million. Of course, if we were given a revaluation during the year ended 2014, we would have measured the difference between the fair value in 2014 and the fair value in 2015. Then the difference there is a total of 700,000 rand. So we've done our fair value adjustment, which is the first step. Then the second step is that we need to go and transfer this asset so that it becomes property, plant and equipment. So we're going to say we debit building B PPE, we credit investment property. And here I could have been a bit more clear by saying this is building B. All right, so we're going to transfer it now to our PPE. What do we transfer at? We transfer at the fair value on the date of transfer, which is the 3.2 million. Right, then we now have PPE, and it seems to me like we are told that the remaining useful life of the asset is 15 years as on 1 July 2015. And then they also give us a fair value. Please be very careful with the fair value that is given on 31st December 2015. They are trying to catch you out. This building should be kept on the cost model. If we use the cost model, we will never revaluate the asset. We cannot recognize a revaluation surplus if it's a cost model. So if it had been a fair value model, we would measure a revaluation surplus using this information. But because it is on the cost model, that information will not be used, and we will simply recognize depreciation on this building. So at the end of the year, we're going to debit the depreciation. We're going to credit accumulated depreciation. And we need to go and calculate what is the depreciation. So this asset has only become on 1 July 2015, it became PPE. So if we now measure at year end the depreciation, you will agree with me that we can only measure depreciation for a total of 6 months because it has only been PPE for 6 months, which is July to December. So we're going to take the 3.2 million and we need to divide it by the remaining useful life of 15 years, and we need to times it by 6 out of 12. And that gives us an answer of 106.66. I'm just rounding to 2 decimals because that is money that we are working with here. Right, that is the depreciation. As you can see, we don't do a revaluation surplus. So I'm just going to say, no revaluation. This is the cost model. Just an important side note for you to remember. Right, and that should then be the journal entries that we do relating to building A and B in terms of note number 1. In the next required part, they ask us to do, this was now, of course, note A that we've answered. We need to move on to B. And in B, it says we need to do the calculations for, if we just go to note B, it says note 4, and it tells us that machine C has a net replacement value of 1.2 million rand at the end of the year. So if I go back to my policy, it tells me that machinery is carried on the revaluation model. So now I need to go and measure some revaluation surplus or some revaluation deficit on this asset. So let's see, what entries would we do regarding machine C? So for machine C, it was a 1.1 million rand cost. It has a residual value. This asset is kept as PPE, so it is not an investment property. We are not told that it is rented out, so therefore the residual value will be taken into account. They tell us the accumulated depreciation at the beginning of the year is 100,000. It has a useful life of 10 years, and then there's a straight line method that is used to depreciate it. So in this calculation, we're going to start by saying at the end of the year, we need to recognize some depreciation on this asset. So we're going to debit the depreciation. We're going to credit the accumulated depreciation on the machinery. And now we need to do a calculation. So if I look at machine C, it is with a cost of 1.1 million rand. We need to deduct the residual because this is not investment property. We are not explicitly told that it is rented out. And then we need to divide it by 10 years. It would seem to me like we had the asset for the whole year because we already had accumulated depreciation for it at the beginning of the year, so it should have existed at the beginning of the year already. So the depreciation that we're going to account for here is then the 1 million rand basically, because we need to minus the residual divided by 10 years, which gives us 100,000 rand. The next step in revaluating is that we need to go and eliminate all the accumulated depreciation, and we need to write it off against the asset. So we will then, of course, debit the accumulated depreciation account. And we will play it off against the asset, which is machine C, PPE. We need to calculate the total depreciation. We are told that the depreciation at the beginning of the year was 100,000 rand, and we've just added this 100,000 rand to that account, so I'm adding it as well. And that means the total depreciation, accumulated depreciation, is 200,000 rand. Right, the next step is we need to measure the revaluation surplus or the revaluation deficit. So how do we do that? We need to compare the carry value of the asset to the net replacement value. So this is just then a calc. We are told that the net replacement value of the asset on the 31st of December in note number 4 is 1.2 million. We need to calculate our current carry value, and the carry value will be, of course, the cost minus all the accumulated depreciation. So it will be the cost price of 1.1 million minus all the accumulated depreciation, which was a total of 200,000, which gives us a carry value of 900,000 rand. So the carry value in the books is 900,000 rand. We need to get it to be 1.2 million rand. So it needs to go upwards, which is a revaluation surplus. And the difference between the two is then a revaluation surplus of 300,000 rand. This is just my calculation, so I am just putting it in a block. And at this point, we're going to say we debit then the asset. So we debit machine C, PPE, and we will credit the revaluation surplus, and we have a total of 300,000 to recognize there. Righto, so that is the entries that we would have done in terms of the note 4. In required number C, they ask us to complete the journal entry that relates to note number 5. And this was a situation where we had to recognize an impairment loss. So how do we recognize an impairment loss? We must first depreciate the asset, and then we need to use the fair value less cost to sell and value in use to determine the impairment loss. Right, so if I look at calculations for note number 5, I'm going to say the first thing I need to do is on 1 August 2015, I need to recognize depreciation on this asset and also accumulated depreciation on vehicles. If I look at the information relating to vehicle 01, it had a cost price of 200,000 Rand. If we just go back to vehicle 01, it had 200,000 Rand cost. It had an accumulated depreciation of 75,000 and a 4-year straight line life span. So now we need to go and calculate some additional depreciation on this asset. So I need to take into account it was then used between 1 January and 1 August. The depreciation calculation there is 200,000 Rand divided by 4. There's no residual value. And we need to times it, and now we need to go and calculate. It was January, February, March, April, May, June, July. August, I will not be counting because this accident happened on the 1st of August. So it is 7 out of 12 months. If I do this calculation, I get to a depreciation of 29,166. I'm just going to round it again to 2 decimals because we work with money. Right, that is the first step if we have to measure an impairment loss. The second step is that we have to compare the carry value of the asset to that of the higher of fair value less cost to sell and value in use. So let's first look at the carry value of this vehicle 01. And the carry value will be the cost of 200,000 minus the accumulated depreciation at the beginning of the year, 75,000, minus the depreciation that we just calculated in the current entry, which means the carry value of the asset was 95,833 Rand and 33 cents. Then we need to go and find fair value less cost to sell. If I look at the information provided in note number 5, the fair value of the asset was 50,000 minus the cost to sell, that was 2,500. The value in use was given as 55,000. Between fair value less cost to sell and value in use, we need to pick the higher value, which is 55,000 Rand. So it's going to be the difference between the current carry value and the higher one of these two. So I need to say the impairment loss is thus, is then the difference between the 95 and the 55, which gives me 40,833 and some odd cents. So if I now have to go and book this as a journal entry, I am going to say I debit impairment losses. I credit the accumulated depreciation, which is for vehicles, and we've just calculated the total there. Right, that was the impairment loss in note number C. We are on note number D, and that asks us to do calculations for note 6. If I look at note 6, it says here that the vehicle O2 was stolen on 1 February. The insurance paid out a claim of 220,000 Rand on 3 February. Right, so what do we do when something is stolen? Well, on the 1st of February, we will have to first indicate depreciation on this asset. So it's going to be depreciation and accumulated depreciation that we use here. And what will be the depreciation here? Well, the year end is December, which means the year starts in January, and it was stolen on 1 February. So it was only in use for 1 month. We will not add February because it's the 1st of February. So if I look at the information relating to vehicle O2, which is listed here, we need to take the cost price, 250,000, minus 50,000 residual, because this is PPE, and we need to divide it by 4 years and times it by 1 month. If I calculate that depreciation, it is basically 200,000 Rand divided by 4 times 1 month, and I get 41666. Again, I'm just rounding to 2 decimals because we work with money. Great. Then we have the depreciation. Now this car is stolen and we are paid out by the insurance on the 3rd of February. In this case, we're going to say we debit the bank because once the insurance company pays money to us, we get money, 220,000 Rand. And then we need to take this asset out of our books. It should no longer be in our books because we don't have this asset. It is stolen. It is wherever the thieves have taken it. So now I'm going to say I need to take out the asset itself, vehicle O2. So I'm going to credit it by the cost price of 250,000 Rand. And then I also need to take out its accumulated depreciation. And that is on vehicles. And the accumulated depreciation will be the depreciation at the beginning of the year. So they tell us the accumulated depreciation at the beginning of the year was 50,000, and we add to that the depreciation for 1 month that we just calculated because we put it in accumulated depreciation in this credit entry. Now we need to go and see, did we make a gain or did we make a profit or a loss? It would seem to me like we short a credit entry here, so it will be a profit on insurance claim, and we're going to take the balancing figure here, we have made a profit of 24,166 Rand and 67 cents. So that was the journal entries to be posted for note A through to D. And then we can move on to the required number 2. In required number 2, we need to do a PPE note, a property, plant and equipment note as at 31st December 2015. So this is called Bootbusters. Property, plant and equipment note as at 31st December 2015. So now we need to go and consider, but what assets do we have here? So the first asset that I know is PPE, is building A. Then an asset that became PPE is building B. We also have a number of machines. We have machine A, machine B, and machine C. And we also had some vehicles, which was, I'm just going to call it vehicle 1 and vehicle 2. And we need a total column, of course. I'm just going to scroll up so that you can see properly. In the descriptions, we're going to have a cost. Then we're going to have an accumulated depreciation at the beginning of the year. We're going to have a carry value at the beginning of the year. We're going to need some movements. Under movements, we will have, of course, depreciation, revaluation surplus. We're going to have a transfer from investment property. And we are also going to have an impairment loss. I leave a few lines if I have forgotten something. And then we're just going to end off this note again with cost and accumulated depreciation and a carry value. Let's start with building A. At the beginning of the year, it had a cost of 1.2 million. It had an accumulated depreciation of 200,000. It had a carry value, which would be the sum of these two. Then under movement, we recognized some depreciation on it, I remember. If I look at the depreciation, it was 50,000 Rand for building A. So I'm just going to post it, 50,000, and that should be all the entries for building A. So it's going to be the same cost price. We're going to add together the accumulated depreciations, which would now give you negative 250,000. And it is going to be a carry value, which is the difference between the two, 950,000. If we look at building B, at the beginning of the year, it was investment property. So the balances would have been 0. Then during the year, it had been transferred from investment property to PPE. If I look at that journal entry, it was the transfer was done at 3.2 million Rand. So I'm slotting it in. And then we recognized some depreciation on it. So I just go back and find the depreciation on it. And there we go. It didn't have anything else happen to it, so the cost price will be the transfer price, and the accumulated depreciation will be the only depreciation we've measured so far, which is the current year depreciation. And the carry value will, of course, be the difference between the two. Then we have machine A. For machine A and machine B, we have not done any calculations. I am just going to quickly fill in all the opening information. For machine A, it was a 500,000 Rand cost price, and it was 150,000 Rand for the accumulated depreciation. For machine B, it was 600,000 Rand and an accumulated depreciation of 120,000. And for machine C, it was 1.1 million, and the accumulated depreciation on it was 100,000 at the beginning of the year. So we can just simultaneously calculate the opening values for all the machines. I'm just going to start with machine C because we have already done the calculations for it. So let's just go and see what was the depreciation for machine C. For machine C, the current year depreciation was 100,000, and we also recognize the revaluation surplus of 300,000 Rand. Because we've now revaluated this asset, the cost price will be the value at which, want to see the value at which it was fair valued. So that would be 1.2 million. So it is the fair value. And this asset will currently not have any accumulated depreciation on it because we eliminated it, all of it, with this entry because it was 100,000 of the previous year plus 100,000 for the current year. So we took all of that out of the account. So there's zero. And the carry value will then just be the net replacement value. So we can also apply this in all the other machines because they are also revaluated. So the 850,000, which is the fair value at the end of the year for machine A, in the policy we are told we need to eliminate the accumulated depreciation. So therefore we only have the carry value, which is the fair value. And there's also a fair value of 400,000 Rand for machine C at the end of the year. Again, we will eliminate all the accumulated depreciation, resulting in the carry value equals to the fair value. The only thing we now need to go and sort out is to see the depreciations and the revaluation surpluses. So we need to do some calculation for that. So we're first going to do a calc for machine A. And for machine A, we need to go and see what is the rule. They say it's a straight line over 10 years. So we have a cost. We have an accumulated depreciation until the beginning of the year. We have a current year depreciation. So the cost was 500,000. The accumulated depreciation was 150,000. And then the current depreciation will be 500,000 divided by the useful life of 10 years. We've had this asset for the whole year, so the depreciation is 50,000. I just want to type it negative as well. So what is the carry value of this asset? The carry value at year end is 300,000. Then we need to go and look at the net replacement value or the fair value. The net replacement value or the fair value for this machine is 850,000, which gives us an upward movement between the current carry value and what it should be, which is the fair value. And that gives us a revaluation surplus, and which is the difference between these two. So the revaluation surplus in this instance is 550,000. So now I can go and take this information and I can slot it into my PPE note. So under depreciation, it's going to be the current depreciation. Under the revaluation surplus, it's going to be the 550,000. We will repeat this for machine B. We had a cost, an accumulated depreciation, and a depreciation for the year so that we can get to a carry value. The cost price of machine B was given as 600,000. The accumulated depreciation at the beginning of the year was 120,000. And it is a depreciation method 5 years straight line. So we're going to take this divided by 5 years. We had it for the whole year. So that's another 120,000 Rand. Carry value is then the sum of everything. We look at the net replacement value or the fair value. It is 400,000, I believe. So this gives us a surplus of the difference between the two, and that is 40,000. I'm going to go back and just fill it out. So this is depreciation of 120,000 in the current year and a surplus of 40,000. So under revaluation surplus, we get 40,000. Right, moving on to the vehicles. Just want to put my calculation in a nice block. Moving on to the vehicles, we had vehicle 01, and vehicle 01, I believe, had a little problem because of impairment. So I'm again just filling out the opening information. It's 200,000. And the accumulated was 75,000 at the beginning of the year. For vehicle 02, it's 250,000 Rand cost. If we look at the accumulated depreciation, it was 50,000. So the opening will just be the difference between the two. And now we can go and look at the movements. I remember for vehicle number 1, we had calculated some depreciation up till August. So we need to go and find the depreciation that we've calculated. And the depreciation was the 29,166.7. Then we also calculated an impairment loss on it. On it, which was this part. And I just want to check. I think the journal entry that we didn't do here was again the depreciation between August and year end. So we must just add that entry here, because we must measure depreciation again now for the remaining months. So we will debit depreciation and credit accumulated depreciation again, but now we need to use the remaining life of the asset to calculate the depreciation. So we will start with the current value for it that we have in our books, which is 55,000, because we've reduced it by an impairment loss. We've reduced it from 95,833 to 55,000. So the current value for the vehicle in the books is 55,000. We need to divide it by 23 remaining months, and then we need to calculate between August and December. So it was August, September, October, November, December. So there were 5 remaining months left. If I do that calculation, 55,000 divided by 23 times 5, I get depreciation for the rest of the year, 11956, and I'm just rounding it to 2 decimals. So the depreciation that we are accounting for under the vehicle will then be both the two depreciations for the vehicle, before the impairment loss and also after the impairment loss, but before up till the year end. So it should be thus add negative this, and that gives us 41123. So that is then the 199 add the 29166. At the end of the year, the cost price of the asset will still be the original cost price as we've always known, 200,000. And now the accumulated depreciation, just want to make sure it is typed negatively. Impairment losses should be negative. The accumulated depreciation will be the accumulated depreciation at the beginning of the year, add the current depreciation, and add the impairment loss, because the double entry of the impairment loss is accumulated depreciation, as we've seen there. So this will leave us with a closing balance of 43,043, which is then the closing balance at the end of the year. I just want to round it to 2 decimals. Righty, then for vehicle number 2, vehicle number 2 was stolen. So we had recognized some depreciation on it, which is accounted for. And then we need to de-recognize it. So we're going to say here, need to just insert a little line here. This will be disposal at carry value. And the disposal at carry value will then be minused from this account. So the disposal at carry value should then be the cost price minus all the depreciation up till the day of the theft. And you will find that the closing balances should be 0 because you no longer have that asset. It has been stolen. Right, so now we just need to get to a total column, which is basically the sum of everything horizontally. And that is what your PPE note should look like in the instance of this question. Right, we have one more required part left, which is number 3. And in number 3, we need to do the investment property note. So I'm just going to copy this and correct it. And then we can do the investment property note. The only asset that was investment property here was building B. So I'm just going to say building B. So we had an opening balance for it, and that should have been the cost price of 2.5 million. Under movements, we had a fair value adjustment. Income, and we had a transfer to PPE. The fair value adjustment income that we recognized on building B was 70,000 Rand. And then the transfer was 3.2 million. So we minus it because it moves from investment property to PPE, so it's no longer investment property. You would find that in the PPE note, we've added it there. Then we will have a closing balance, and it will of course be 0 because this asset is no longer an investment property. It is now a PPE. I hope that you have enjoyed this question. I think it's quite interesting. It's quite comprehensive, very much enjoyable. Reminds one of a lot of little rules that could have been forgotten. So I hope that you have enjoyed this lecture, and then I will also see you in the next video